Welcome to the Fear and Greed Daily Interview. I'm Sean Aylmer. We talk a lot about the property market here and everybody has a different take on it. Some experts say house prices will keep falling. Others say they're stabilising and will even start climbing again next year. But new research looks beyond the day-to-day price movements in our capital cities to show just how resilient the market is, particularly in times of economic uncertainty. The research was commissioned by investment manager and non-bank lender Zagga. Remember, this is general information only and you should seek professional advice before making any investment decisions. Alan Greenstein is the CEO and co-founder of Zagga. We last spoke to Alan 2 years ago, back in 2020. Plenty's happened since then. Alan, welcome back to Fear and Greed.
Thank you, Sean. Good to be on the show.
Righto, what we all want to know, Alan, where do you stand on property prices? Up, stabilising, down?
Sean, I'm probably the wrong guy to ask because Zagga's business is not so much about residential property prices, although that obviously plays a factor. What we do say is that prices are certainly coming down. We're going to face some economic headwinds. Those are unavoidable, but prices have come off a very, very high base. Asset values have certainly ticked up. There's still a lot of value in the market. And although the newspapers every day are doom and gloom, if you actually look at the underlying fundamentals and some of the research that's coming out, there's a good case to say that property prices are going to hold up. We've had 40 years of growth in property prices and, we talk about this bubble and have done for 40 years, but nobody has seen the bubble yet, and I don't think we're going to see it.
Okay, that's pretty optimistic. Your white paper outlines the resilience of the local property market with a particular emphasis on times of global economic uncertainty. Just explain that to us.
Yeah, so if you look at the history of the Australian market, certainly in parallel with some of the big shocks that have been seen globally, Australia has always batted above its weight in withstanding and dealing with those shocks. So quite interestingly, some of the research shows that our GDP, for a small country, I think we're about 1.7% of the world's population, our GDP is substantially higher than that. We also have a situation where we need migration. We have to import a lot of people to keep the country growing. So we have a situation where there is endless demand for property, which is not the case in many of the other jurisdictions that are out there. Of course, the fact that we're an island and we only have so much land and can't extend beyond those borders is important in terms of just how we finance that property and where we put it. And overall, the economic fundamentals of the country in terms of the strength of the underlying property base, the strength of the economy, you can read in the paper today about iron ore exports, steel exports, all of those things that are happening, the way in which we've managed COVID, and generally speaking, the fact that unemployment is still pretty low, although wages are an issue. All of those things suggest that, yes, while interest rates are going up, there is underlying affordability and property prices, although they may reduce in the short term, are unlikely to properly crash or collapse.
Okay, so this is kind of the big macroeconomic picture. Now, Zagga focuses on commercial real estate debt. How do we think about that in terms of, as an investment class? How do we think about that?
That's a good question, Sean. So I would just like your listeners to understand what we mean by commercial real estate debt.
Yep.
So what we're doing here is we're not talking about a property which is owner-occupied or owned by an investor for residential purposes. We're not talking here about funding the end user. What we're talking about here is using a commercial property as security for a loan, which is effectively an annuitized investment for the investor. So that commercial real estate loan, it could be a business loan underpinned by, say, a warehouse which is unencumbered. So a businessman is importing new widgets and he needs some funding. It could be for a managed buyout. It could be to fund a developer who's developing a property. Yes, that property could have a residential outcome, but we're not funding the end user. It could be for industrial purposes. For Zagga, we don't do agricultural, we don't do residential owner-occupied, and we don't do special situations. So we believe that if you consider that market, there is more than enough growth and potential for that market. And commercial real estate is effectively, in our view, going from strength to strength as the banks are becoming less competitive in that area and the non-bank lenders are becoming more competitive in the area. The advantage for an investor is that you effectively have an investment in an underlying property without having to own the property. So you're not bound to the ups and downs of the pricing cycle. Secondly, you can get a clear and transparent return, which could be over a fixed period or over a period that is to your choosing. And the third thing is you're getting a very good investment, which is uncorrelated to equity markets or uncorrelated to currency markets, which could be at a very strong LVR. For example, on our portfolio, across what we've now done over $1 billion worth of loans, our average LVR is 63% across the portfolio. So the property market has to go down by 37% across the board before you lose $1 of capital.
Stay with me, Alan. We'll be back in a minute. My guest this morning is Alan Greenstein, CEO and co-founder of Zagga. So you're a good person then to ask, if we're looking at that commercial property market, is it something that, where industrial is likely to do better than office or retail? Like, what's your take on that? Because if I am interested in your organisation, I do actually want to know what you're thinking about in terms of the types of commercial property out there.
Yeah. So, Sean, we're not big into office space. Just from a Zagga point of view, we kind of tap out at about $40 million, and offices are much bigger than that. So we leave the office space to the much larger developers. And I'm certainly not an expert on that market, so I'd prefer not to speak about it. But outside of the office space, we see tremendous demand for mixed use commercial and residential. So just think about the area where you live, putting up a development which has got a couple of basements of parking, 1 or 2 floors of commercial, could be a doctor suite, could be a gym, could be a restaurant, could be a vet, could be a pharmacy. And above that, 3 or 4 or 5 levels of apartments. Could be 2-bedroom, 3-bedroom, a penthouse. There's insatiable demand for that. We also think that there's a very strong case for medium density residential coming through. As more and more skilled workers come into the country, we believe that the government's going to allow 195,000 extra skilled migrants on top of the quota over the next couple of years to make up for the shortfall. If you consider that we have a downsizing population, people leaving big houses into smaller, there's a big market for that. Industrial is very much a horses for courses. You're not going to put up an industrial site in the middle of a residential area, but there are plenty industrial opportunities out there, small warehouses. We have a country and an economy which is based on small businesses, on owner-managed businesses, and these are the kind of people who build or who use these industrial sites. So a small warehouse somewhere, if you're a carpenter, if you're a welder, a mechanic, a panel beater, all those kinds of things. So we see a lot of demand across the eastern seaboard for that.
Okay, so how does inflation play into this? Because I always thought that rule of thumb, inflation wasn't good for property investments.
Yeah, that's a good question. And I think that from an inflation point of view, we've got to think about whether it's on the buy side or the sell side. I think it's almost common cause that in Australia today, a lot of the inflation we're seeing is largely COVID related and has been driven by supply side shortages, by labor shortages, and by, in certain instances, just the lack of being able to get product from one country to another. So that's different to where the government has been printing money. Clearly, a lot of money was printed in order to get the COVID bill paid, and we're paying the price for that. And in order to combat that inflation, we're now seeing an increase in rates. But if you have a look at the correlation or the lack of correlation between the increase in rates and property prices, there are still many postcodes in Australia where property prices have gone up. Sydney, for the year to date, is only 10% down. And during the whole of COVID, it was down 1.7% and came off a high base. So if you consider the impact of inflation, I don't think that inflation is as heavily impacting the underlying asset values as it's impacting, say, the cost of living, which is where it's really hurting. If you're an investor in say, a commercial real estate debt project, what you're really doing is you're funding getting that building out of the ground by and large, or you're funding the holding of an asset until the right time has come, or you're funding some business purpose. The inflation is already built into that. When we're funding a loan, we know what it's going to cost and we have a sense of where the inflation is. We're not going to get hit all of a sudden by the inflation. So I actually think that these kind of investments could be a hedge against inflation. Bearing in mind, your return from day one, it's effectively a fixed return. The asset that you're funding against has got pretty deep pockets in terms of the LVR, and you're not going to get impacted by price increases on a day-to-day or a minute-by-minute basis, which is the case when you're trying to fill your basket of groceries or you're trying to fill up your car at the servo.
Okay. Alan Greenstein, the other thing we spoke to you about a couple of years ago is peer-to-peer lending, because Zagga is big in peer-to-peer lending. How has that performed in the past couple of years?
Well, Sean, we prefer to think of ourselves now as more of a non-bank lender. I think the term peer-to-peer is probably a little bit out of vogue, but it's gone certainly very well for us. I mean, we have now gone through $1 billion of originations in the 5.5 years we've been going. We've written well over 200 loans. If I speak to some of our clients and the many of our competitors who are out there, and we have pretty good relations with a lot of them, it seems to me that there are many, many borrowers out there who now look at the non-bank lenders as their first port of call for money, mostly because of the flexibility and the agility and the response times. And as far as investors are concerned, certainly when rates were very, very low, the peer-to-peer market was a great place to get a very good and quite secure return on your money. Clearly, as bank rates are increasing now and our returns are kind of a little bit, although they've gone up, the margin between what the bank was paying and what we were paying is much lower today than it was then. Obviously, liquidity is a little bit tighter right now, but I think that liquidity is also associated with just general lack of confidence in the market, and I believe that will disappear. So peer-to-peer or non-bank lending is alive, it's well, it's here to stay, and I think every day it claws a lot more of the market back. It's only about a 50 billion per year market today in Australia, and that's significantly less than the same size of the markets in the UK or the US. So here's hoping.
Alan, thank you for talking to Fear and Greed.
Thank you, Sean. Pleasure to be here.
That was Alan Greenstein, CEO and co-founder of Zagga. This is the Fear and Greed Daily Interview. Remember, this information is general in nature and doesn't consider your personal circumstances. You should get professional advice before making any investment decisions. Join us every morning for the full episode of Fear and Greed, Australia's most popular business podcast. I'm Sean Aylmer. Enjoy your day.